Welcome back. Low sales, rising inventories and limited access to fresh capital. Well, if this wasn't worrying enough, the real estate sector in India now has to figure out ways to cope with rising debt. Experts warn that debt levels are now reaching breaking point. Niranjan Hiranandani gets you a behind-the-scenes look at the unfolding crisis.
Cash prices, international trips and massive discounts. Just some of the freebies on offer as IndiaProperty.com kicked off the largest online home sale in India. But behind the variety of offers lies the sheer desperation of builders hoping to quickly get rid of their inventory and raise funds.
I mean, it's not something that can be wished away. And then therefore, as a result, there is a lot of support for liquidation sales like this. In fact, cost of carrying a particular inventory is today no point in incurring a cost of carrying capital. I might as well pass it on as a discount so that you can get the cash flow right back in.
Freebies and offers like these have now become commonplace as low sales and rising inventories take its toll. Data from Knight Frank indicates that sales volumes dropped by 17% in 2014 compared to the previous year. Residential sales in particular were at a 3-year low in the second half of 2014. This has put considerable pressure on developers who have been juggling around with high debt thanks to new land acquisitions, big projects and private equity buyouts pushing up debt levels.
Obviously, it's a significant worry because most of the debt, and I think it's much more than 40,000 crores, is concentrated in top 7 or 8 cities. A major bulk of it is actually in NCR and Mumbai.
With buyer sentiment still low, developers are now looking at alternate methods to raise funds and cut debt. Real estate giant DLF, which has a debt of a little over 20,000 crore rupees on its balance sheet, is considering selling properties and launching REITs to cut down on its debt. While Mumbai-based Lodha Group has recently sold dollar bonds at a 12% yield to raise $200 million. Experts say the impact is expected to be worse for smaller developers, including unlisted firms, which form the bulk of the real estate sector in the country.
We understand that the smaller players will find it increasingly more difficult to sustain itself. So gradually, more and more organized players will start consolidating their grip over the real estate market.
It is true that certain companies are like that, but it's not that all companies are in difficulty, and this is something people are just dreaming about. Of course, the markets are a little soft, but the overall economy is just picking up.
However, experts claim that many of these players may have now run out of options and will now have to turn to expensive private equity infusions and private loans.
A majority of developers actually have exhausted all their pools of capital. They're over leveraged. They've already, their assets are already encumbered. I don't think they have any other way of going to the market and actually leveraging any asset and raise capital.
Developers are now hoping that the economy will pick up in the next 6 to 10 months and thus bring back buyer sentiment. But if that doesn't happen, then real estate debt levels may soon pass the point of no return. From Mumbai, Niranjan Hiranandani, NDTV.
Our next caller is Ganesh Pawar. Ganesh, hi, go ahead.